Welcome to BD Daily Finance News Podcast, your daily briefing on finance and investing. Today is 2026, July 20th, and the market menu includes AI chips, sandwich IPOs, oil anxiety, China rotation, and Boeing's financial repair job.
That is a full buffet. Nothing says responsible wealth building like Nvidia, crude oil, and a sub-sandwich trying to become a Wall Street celebrity.
Story 1. CNBC reports Bezos-backed CuspAI is teaming up with Nvidia to hunt for new chip-making materials. The key point is that AI investment is moving beyond software and into the physical supply chain.
So we are no longer just asking AI to write emails. We are asking it to find the magical ingredients that make chips less expensive, faster, and hopefully not as available as concert tickets.
Exactly. Imagine the semiconductor industry as a kitchen where every recipe depends on rare, precise ingredients. If AI helps discover better materials, it could reduce bottlenecks and improve margins across chip manufacturing.
And for normal investors, the lesson is not buy every company with AI in the name. That strategy has the sophistication of buying a gym membership and calling yourself an athlete.
Right. The actionable angle is to track the second-order beneficiaries: materials, data centers, power, cooling, equipment, and firms with actual revenue exposure, not just inspirational slide decks.
Story 2 is my favorite because it has bread. Bloomberg says Jersey Mike's and its backers are seeking up to $1.09 billion in an IPO, which proves carbs can have a roadshow.
Consumer companies are joining the U.S. listing rebound. For Jersey Mike's, the public market pitch is likely about brand growth, franchise economics, store expansion, and predictable consumer spending.
I slightly disagree with your calm professor tone. A sandwich chain IPO can be exciting because food is resilient. People may delay a new laptop, but lunch still attacks at noon.
Fair pushback. But public investors will still ask whether growth is profitable growth. Restaurant IPOs can look delicious until labor costs, rent, food inflation, and valuation multiples show up with a calculator.
So the simple version is, a franchise model can be like renting out your recipe. Nice if the royalties flow, dangerous if expansion gets ahead of quality control.
Story 3. Bloomberg reports stocks climbed as the chip rout paused, while oil steadied. Traders are watching big tech earnings to see whether volatility continues or momentum returns.
The chip rout paused. That sounds like the market hit the treadmill stop button, leaned on the rails, and pretended it was part of the workout plan.
The finance behind it is straightforward. When a crowded trade falls hard, even a small pause can create relief buying. But that does not automatically mean the long-term trend is fixed.
And oil matters because it sneaks into everything. Gas, shipping, airline costs, groceries, delivery fees. Oil is the friend who says they are just stopping by and then eats your entire budget.
For households, this means watch energy-sensitive spending and avoid overreacting to one green market day. For investors, earnings quality matters more than whether a stock bounced before breakfast.
Story 4. Citi upgraded China to overweight amid AI volatility and geopolitical friction. That sounds like saying, the kitchen is smoky, but the chef may still know what they're doing.
SCMP reports Citi sees China as a candidate for capital rotation, even while acknowledging weak relative earnings per share momentum. In plain English, investors may be underexposed if the rally broadens.
I want to be excited, but overweight China during geopolitical friction feels like ordering soup on a roller coaster. Possible, but please secure the napkins.
That caution is valid. The opportunity is valuation and positioning. The risk is policy, earnings weakness, and global tension. This is diversification territory, not all-in hero behavior.
So normal people should hear, rebalance. Do not cosplay as a hedge fund. If your emergency fund is missing, do not make geopolitical alpha your personality.
Final story. CNBC reports Boeing CEO Kelly Ortberg said the company still needs a couple more years to repair finances before developing a new jet. That is a major capital allocation signal.
A couple more years to repair finances is corporate speak for, we are not buying a new couch until the credit card stops smoking.
Boeing's decision matters because aerospace has long cycles, heavy debt needs, supplier networks, and safety-sensitive production. Investors should focus on free cash flow, delivery stability, and balance sheet progress.
And workers and travelers should care too. A financially healthier Boeing can mean steadier jobs, better execution, and fewer dramatic headlines that make passengers stare suspiciously at the wing.
Today's recap. AI investing is moving into materials. Jersey Mike's tests IPO appetite. Chip stocks are not out of the woods. China may be a rotation trade. And Boeing is prioritizing repair over reinvention.
Translation. Follow the cash flows, respect the risks, and never let one green candle convince you that your portfolio has become a genius. Like, subscribe, and tell us which story you are watching next.